fresh round of trade talks between the US and China kicks off today as Washington officials head to Beijing. The two sides will descend to pick up where they left off in Washington in April. However, some experts are skeptical that a deal can be reached until later in the year. Joining me now to discuss the outlook for US markets is Bob Iaccino, the chief market strategist at Path Trading Partners. Bob, so good to have you on. What are you expecting from the latest trade talks and what could it mean for markets?
Well, I think you have to look at the trade talks two ways. One of the ways would be, what would they like to announce? This particular administration that we're in right now, President Trump and his crew, essentially enjoy when the stock market is higher. So I think the rhetoric, which has happened with every administration, it's not a political statement, but the rhetoric is going to be positive after this set of meetings, I believe, simply because of the pressure the markets have been under. If you kind of look at the history of the rhetoric versus what's happened with the market, you very rarely see negative commentary out of the U.S. side of these talks when the market has been lower for a few days. They're very cautious about that. They very much tie the success of their policies to the direction of the stock market. So I'm expecting positive rhetoric. I don't know. The important thing is if we get it out of both sides. We've had times where the official Chinese news agencies have been positive at the same time that the U.S. rhetoric has been positive. That, to me, is the key, what China says, not what the U.S. says.
All right, so let's focus on what China's saying there. But U.S. futures are pointing to a slightly weaker open, extending the losses from yesterday, particularly in the tech-heavy NASDAQ. So do you see further upside for the major averages from here, or do you think we're starting to roll over?
Well, I do see further upside, but in the short term, I think we have to roll over. And I have two reasons for saying that. Number one, we got a revision of fourth quarter GDP just a little while ago that was decidedly weak. I mean, 0.4%. I think this was about the 45th revision of the fourth quarter. 0.4%, I'm sorry, the first quarter, 0.4% is a big revision. If we end up getting the first quarter of 2019 somewhere 1.5%, it's going to be difficult for the entire year to be close to 3%, which is where the president wants it. So I think that's a little bit of the negative early direction you see in the futures market. Number two, at this point, the trade war has gone on for so long that it's going to take a quarter and a half, possibly 2 quarters. Even if we announce a deal today, even if we implement one before the end of this quarter, it's going to take a quarter or two for that to feed into earnings and feed into economic growth. And then lastly, specifically the EU, China as well, we've seen a lot of negative economic data. So is there a global recession looming? I don't know if I'd use the word recession. Recessions have a technical definition, and I don't think that word should be thrown around as flippantly as it is in current times. But it's definitely a slowdown. There's no questioning that the world is slowing down. So again, quarter 2, 3 to get out of this, I think it's not unreal to expect that's how long it's going to take.
Well, on the subject of a potential slowdown, there has been a lot of discussion about the yield curve inversion between the 3s and the 10s. So do you see that yield curve inversion as a harbinger of a recession, or is it more of a reflection of where we're at in terms of US monetary policy?
Well, it's a little bit of both. I don't see it necessarily as sort of vultures circling the recession carcass. I don't look at it that way at this point because it's simply a very small inversion for a very short period of time. We were less than 10 basis points yesterday. I haven't checked it this morning yet, but the particular sector of the curve worries me. 3 months to 10 years is an important sector in terms of being a recession indicator. Having said that, I think it has as much to do with the slowdown in Europe combined with U.S. monetary policy. If you have the Bund at negative yields, the 10-year looks attractive for those who have to buy yield. So they're going to buy the 10-year, pushing that yield lower. There's no medium-term buyers of the 3-month T-bill. So obviously with the pause by the Fed, we're not talking about cutting from the Fed yet. So that would be the next step, and that would probably right the curve a little bit if that happens. So I'm not worried about it yet, but if it gets deeper and it drags on longer, then obviously we have to pay attention to it.
Well, let's talk about the Fed then, because do you think that the central bank was essentially pandering to the market volatility, or it was the right decision to move more dovish at its latest policy meeting?
So yes and yes. One of the things I think is that people talk about this being a pivot. It was difficult last year for the Fed to let the markets know what they thought of the data that they kept saying they were dependent upon. So if they're data dependent and the data is coming out every month, with some things like some commodities, it's every week. If they're data dependent, yet they only have a press conference every second or third meeting, it's very difficult to turn that sort of ocean liner of the Fed around and let the market know this is happening. They were starting to let people know in their speeches, in their rhetoric, and then we have a press conference and the Fed says the data's changed. This particular year could be different because Chairman Powell has scheduled a press conference after every single Fed meeting, so they're actually able to communicate more. So I think they did the right thing. I think they could pivot just as quickly the other way, but as I mentioned earlier, it's going to take some time once there is a deal done, and I am saying there is going to be a U.S.-China deal. I just don't think it's going to be soon. When there is a deal done, it's going to take time for that to flow through, so the Fed kind of has some runway to turn the ship around again if they need to.
So the US dollar appears to be in recovery mode at the moment from the lows seen around 8 days ago. What's your outlook for the greenback? Do you see us continuing to grind higher despite a pause from the Fed?
I mean, at the risk of using an old cliche, it's the best house on a bad block. I mean, if the Fed has turned to a pause and other markets, again, such as Europe, we've already seen stimulus out of China. Japan is an endless stimulus. So which currency do you buy if you're going to buy one? You certainly can't buy the pound right now with what's going on with Brexit. By the way, it is fun to see one other country with some domestic political chaos other than just us. You can't buy the pound, you can't buy the euro, you can't, not long term. Having said that, I think the dollar's overvalued versus what the Fed is doing and what the economic circumstances are. But I think you have to be in US dollars, especially if you need commodities.
And when we talk about the equity market, where do you think the opportunities are sector-wise at the moment in the US?
That's an interesting question because I don't really love any of them. I would say that if you look at the energy sector, that's probably a decent place to be in. But being here in Chicago is kind of the commodity futures hub. I always tell people I'm bullish on oil. So if I'm bullish on oil, you know it's 100% correlated to crude oil? Crude oil. So I'm going to actually play in the, I shouldn't say play, that's not appropriate. I'm going to actually invest in the crude oil sector. If I'm bullish crude oil, I'm going to buy crude oil futures. So if somebody is specific to where they just can do ETFs and stocks, I would look at energy over pretty much everything else. I don't like financials right now. Technology is good medium to long term. It's going to be good for the next 10 years. So if technology dips, you're going to always want to accumulate technology stocks. So I like the tech sector. And then there's always healthcare. The population is getting older and sicker. So as you get dips in there, you're going to want to look for that.
Bob, thank you so much for your time.
It's good to be here.
That was Bob Iaccino, Chief Market Strategist at Path Trading Partners, joining us from Chicago there. I'm Victoria Scholar, and we'll see you very soon.